Hi everyone, and welcome to the Buffett and Beyond Research Saturday Market Recap Letter, January 20th, 2024, and what a week it was. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And this market, well, after the beginning of the week with the market looking like it wanted to continue down, lines of support held, and Thursday and Friday saw pent-up rally buying coming into this market as consumers are feeling great about jobs and lower inflation. Soft landing is the word we're looking for, folks. And weekly stock analysis video, Arista Networks is a leading supplier of cloud service providers. Is this company we should be considering for our growth portfolio? How about a 1-year return of 135% or maybe a 5-year return of 350%? I think these returns are going to make us all take notice. And our ETF video, well, the tech ETF gave us a great buy signal along with our combination ETF. And we took our hedges off and we are letting the stocks run. And let us look at the S&P 500. And last week we were talking about when these lines come together, the red lines are volatility bands, center line is the 20-day moving average. When these lines start coming together, the market is going to shoot up or down pretty violently. And we kind of thought it was going to go down because it started going down, and it opened, or I should say it closed absolutely below the 20-day moving average. So that meant, we're going to go down and we're going to test this bottom band down here. But then all of a sudden, the market tested, the other indices tested their 20-day exponential moving average, bounced off it, and then Friday gapped up, or Thursday gapped up, and then Friday gapped up again. So now we're sitting above this top band, and when you get above the top band or the bottom band, you are having a strong directional pull, or I should say push, in that direction. So with the market closing up above, and this is the S&P 500, with the market closing above that red band, that means more upside action, folks. Maybe we'll take a little breather and then come back up again. So that's what usually happens when we see this kind of formation. And down here, it looks like this blue line wants to turn up above that red line, and we're right at it. So this is a very, very important spot in here for the S&P 500. But let's look a little further. When we look at a little bit closer, we look at then, this is the Dow Jones Industrial Average. We can see, first of all, that we are at new highs in here. This is very, very important. And it did it on pretty heavy volume. See these vertical gray lines in here? That represents the volume when the market closes up for the day. So we have some nice volume, especially the second day, Friday, which is right here, was greater than Thursday. That means the Thursday rally that started it all, and you can see us bouncing off this 20-day exponential moving average, bouncing off it and gapped up, and Friday was just a wonderful, wonderful day on heavier volume. So we like that. Now the question is, will this indicator, which is our intermediate term indicator, turn up? So that's what we're looking at. But let's look a little further at the other indices. And when we look at the S&P 500, well, we see new highs in here, folks. This is very, very important because we've been playing with this high in here once and twice, and about 2 years ago. Don't forget, we're at a level that 2 years ago held, and we thought we were being rejected. That was the whole point of all of this in here, this decline. But then all of a sudden the market took off again, and now you can see this intermediate term indicator on the S&P 500 actually touching that red line. So the black line is touching the red line, and looks like it wants to go up in the up direction. Now let us look at the QQQs. No doubt about it. New highs in here, new highs, high volume. Look at this volume in here, and a definite buy signal on the intermediate term indicator. Now in our ETF letter, we show the tech sector ETF the same way, except more of a crossover down here. So the techs are leading the way. Semiconductors, which have been lagging, are starting to catch up. So we're looking at those indicators, and then our combination triple ETF, which we've made up ourselves, which consists of the tech ETF, the semiconductor ETF, and the top stocks from the QQQs. So it's really pretty much a technical portfolio, and it is doing wonderful. We took off our hedges, and we're letting the stocks run. So we have some nice start, or a nice start to the year after the first part of this month wasn't so hot. So we'll see what happens on Monday or Tuesday. But folks, we will probably come back down and test this line in here, and or maybe go up and then come back down and test. And if that test is successful, these old highs are old highs. And we're going to establish new highs going along. So the next couple of days are very, very important in here. But boy, oh boy, it sure looks good. Notice the two gaps in here. A gap up on Thursday, a gap up on Friday morning. So we kind of like that. That indicates strength. There was a lot of pent-up demand. And again, high volume, these gray lines, nice high volume. We like that. So the tech stocks are leading the way. Semiconductors and the technical stocks that are in the QQQs. Now remember, the QQQs represent the 100 largest stocks in the NASDAQ minus any financial stocks. So it's a very, very good indicator, which is one of our favorite indices, by the way, because the QQQs do outperform the S&P 500, but with more volatility. However, we do have hedging in place at times when we feel the market is going down. But right now, what is the feeling in here? Yeah, it looks pretty good, folks, especially with this turnaround in here. And then we'll go from there next week. And our signals absolutely all turned up. Now, the intermediate term Dow is still down. These are the short-term indicators. They all turned up by Thursday. And then the intermediate term indicator on the Dow, as we showed, is still pointing down. But on the S&P 500, it's turning up. It's just another day of up movement, and that will give us an up signal. QQQs are definitely up, and yes, we took our hedges off. Those of you who want hedging on the ETF that we formed, which are the combination of the semiconductors, the tech stocks, and the top stocks from the QQQs. So we have that one portfolio that's becoming a very, very popular portfolio, and that's up more than the market by about 4 or 5 times. Now, the market's not up very much since the beginning of the year because we were at the top, and we were trying to break through that old top, and finally did. And that's when we took the hedges off. And we said, okay, just let those stocks run. So the S&P 500 is up less than 1%, but our ETFs are all up more than the market, in one case by 7 times. In fact, if you just took the semiconductor ETF itself, we're up over 7% right now, close to 8%. So those indicators, those ETFs that we are monitoring and hedging are doing very, very well, folks. So what about those of you who want portfolio protection by the use of puts about 12% below the market? We call disaster insurance. The January put expired yesterday, and I'm talking about Friday, and we rolled over into the April 19th. Actually, we didn't roll over. We just let the January put expire, and we bought an April 19th SPY 410 put. Now, folks, let me tell you something. The April 19th SPY 410 puts are so inexpensive. They are so cheap right now. Everybody is thinking this market is going to go up. Why? Because even one of the bank presidents, Bank of America, I believe it was, said that he expects 6 rate cuts this year by the Federal Reserve. Now, the Federal Reserve is staying conservative and saying, gee, we just might not lower interest rates in March, but of course they're going to say that. They're not going to tell us that they're going to lower it, and then in case something happens, they have to raise or keep it the same. So they're sort of saying, no, don't count on it. Not that we're going to lower rates or not that we're going to raise rates, but just don't count on the lowering of the rates at this particular time. And that's exactly what we expect the Fed to say. So we'll see, folks. We're going into this year, even if they don't lower rates in March this year, with inflation coming down and an election year, I think we're going to see a pretty good market in here. And if last Thursday and Friday are any indication of what this market could do, watch out above. So, folks, we had a terrible week in the beginning of the week where everybody was scared and everybody was saying, watch out below. And we had hedges on. And then all of a sudden, Thursday and Friday said, the heck with that. We're tired of going down. We're going back up. We did not breach lines of support. And that was the 20-day exponential moving average on the indices. That line held. And once that line holds, there's no place to go except up, at least for a while longer. But don't forget, we're at the top, we're overbought, so yeah, there's always that doubt in there. But folks, listen, we ended the week on a great note. We're at new highs on the indices, so let's take it easy. Let's enjoy the weekend, whatever you do. If you're in the South, take a walk on the beach. Stay safe. If you're up north, go take a walk in the snow. Be with your family. Have a great Sunday dinner. Stay safe. And, folks, we'll see you back here next week.